Welcome to Quantified Strategies, and in this video we show you 3 dual momentum trading strategies complete with trading rules, settings, and historical performance. We show you what a dual momentum trading strategy is, we look at historical performance, and show you how you can implement it yourself. We show you dual momentum between stocks and bonds, dual momentum between stocks and gold, and the famous dual momentum strategy by Gary Antonacci. The last strategy is the best one, so we recommend staying until the end. By the way, we're always working hard to create new and exciting content, so your likes and subscriptions really help us out. Thanks. Let's show you the trading rules of the first of the 3 dual momentum trading strategies. It trades S&P 500 and long-term Treasury bonds. We use the ETFs with the ticker codes SPY for S&P 500 and TLT for Treasury bonds. The trading rules and settings are very simple. At the end of every month, buy the ETF that has performed the best over the last 3 months percentage-wise. That's it. Rinse and repeat every month. Momentum has historically worked best between 3 and 12 months, hence the setting of 3 months. This is a momentum strategy, but we can also call it a sector rotation strategy. For example, if today's the end of June, you buy the asset that's performed the best since the close of March. The equity curve shows that $100,000 invested in 2003 is worth $920,000 today, but performance has been weak after 2020. The annual return of 11.5% is high. How much better than buy and hold each of the 2 ETFs and max drawdown is also significantly lower at 30%. The worst drawdown happened in 2022 when both stocks and bonds suffered a major bear market, something that's not happened often in the past. Before that, drawdowns were moderate and short in duration. There are only 2 losing years, 2015 and 2022, but the majority of the years had double-digit growth. Let's go to the second dual momentum strategy. This one trades S&P 500 and gold, and we use the ETFs with the ticker codes SPY and GLD. This dual momentum trading strategy is similar to the first one, except that we swap TLT for GLD. We use a 3-month look-back period to measure momentum, and we go long the asset with the best percentage performance over the last 3 months. Then we rinse and repeat going forward. The strategy has performed well. $100,000 invested in 2005 is worth $920,000 today, which is an annual return of 12.8%. You're invested on average 5 months in an ETF, and the max drawdown is 34%, which is much better than SPY's 55% drawdown. However, if we zoom out and look at the longer time horizon, the strategy has not performed so well. It was not until 2005 the strategy started working really well, but part of this is explained by the very poor performance of gold for almost 2 decades after 1980. Let's show you the third and last dual momentum trading strategy, Gary Antonacci's dual momentum. Gary Antonacci published the dual momentum strategy in his book Dual Momentum Investing, which he released in 2015. And this is a trend-following strategy. The trading rules are a bit more complex than the first 2. It trades 3 different assets, U.S. stocks, foreign stocks, excluding U.S. stocks and bonds. For our backtest, we use the following ETFs: SPY, EFA, and AGG. Let's look at the trading rules. At the end of every month, rank all 3 ETFs based on the performance over the last 12 months. If bonds performed better than SPY, then you buy bonds and hold it for the next month. If SPY performed better than bonds, then you buy the best performing ETF of SPY and EFA. Then you rinse and repeat at the end of every month. Gary Antonacci backtested the strategy back to 1950, and it's outperformed massively with substantially lower drawdowns. The table shows that Gary Antonacci's dual momentum strategy performed 4 percentage points better annually. That's a massive outperformance. Can you expect this to continue, or is this a curve-fitted strategy? Let's find out how it's performed after the strategy was published. We coded the trading rules into our trading platform and backtested it. $100,000 invested in 2004 is worth $328,000 today, which is a rather lackluster 6.1% per year, something which is significantly below the long-term average of the strategy. One of the reasons is the huge drawdown in 2022 of almost 30%. The drawdown was moderate during the financial crisis in 2008, But there was nowhere to hide in 2022 when both stocks and bonds crashed. This happens often when you're backtesting. The worst drawdown is yet to come. We've shown you 3 dual momentum trading strategies, but none in this video is investment advice. Always make sure you do your own research that fits your investment goals. We'll now answer a few frequently asked questions about dual momentum trading strategies. Please also have a look at our next video coming up about 3 momentum trading strategies. What's the main advantage of dual momentum strategies? Momentum is an anomaly that's existed for as long as we have stock market data. Of course, that's not guaranteed to continue into the future, but we believe one of the explanations for the anomaly is that we tend to chase winners and human nature is slow to change. What's the best time frame for dual momentum trading strategies? Academic research suggests that look-back periods between 1 and 12 months have worked best historically. As long as the look-back period is within that range and the holding period is within that range, you're likely to find something that works. For example, if a stock or asset is outperformed over the last 6 months, you can backtest its performance for the next 1 to 6 months. Thus, momentum investing has proved to work best in the past on monthly bars. What are the different types of momentum trading strategies? There are 2 types of momentum trading: relative momentum and absolute momentum. Is a dual momentum trading strategy easy to implement? We would argue that this is one of the easiest types of strategies to implement. All you need is free data to backtest the strategy on, and then go on to check quotes once a month or less when you trade it live. However, easy to implement doesn't mean easy money. There's no easy money in the markets. Do you need to time the market with a dual momentum trading strategy? No. That's one of the advantages with this type of trading and investing. As Warren Buffett, known as the Oracle of Omaha, once wisely stated, trying to time the market is the #1 mistake to avoid. Spending time and energy predicting the optimal moments to buy or sell in the market is exceedingly challenging and mostly futile, often resulting in missed opportunities or premature actions. As Peter Lynch once said, far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. However, dual momentum offers a potential solution by providing a method to identify and capitalize on trends. Is dual momentum the same as sector rotation? In practice, yes, but a sector rotation trading strategy might also be based not only on momentum, but also other types, for example, mean reversion. Are there any disadvantages with dual momentum trading strategies? Yes. And the main disadvantage is capital gains taxes. When you sell a position, you hopefully have a profit and thus might be liable to capital gains taxes. You better have a tax-deferred account. Another disadvantage might be curve fitting. A strategy might work exceptionally well with a 3-month look-back period, but perform a lot worse with a 1 or 6-month period. Would you trust a setting of 3 months if this is the case? We appreciate you taking time to watch our video. If you found it helpful, please give it a like and subscribe to the channel for more content like this. If you have any questions or feedback, please leave a comment below. That was all for today, and we hope you liked it. And please stay tuned for the next video coming up about 3 momentum trading strategies. We also remind you that you'll find hundreds of trading strategies on our website.